37.5 put for a credit of 90 cents opening both sides. All right. On the other side, if we have to exit this, and as long as the stocks continue to move up, then what's going to happen is the credit's going to keep going down, down, down until it becomes worthless. And that's really what we want to have happen in the trade. But let's say that it's starting to get a little edgy. We decide we're going to take this trade off. It's gone from 90 cents down to 10 cents, and we decide, let's go ahead and take our 80-cent profit. Then what we would do is we would close the trade out, reversing the original order. So instead of buying the 35 puts, we would be selling the 35 puts. Instead of selling the 37.5 puts, we would be buying back the 37.5 puts. Again, and we're going to do this for a debit of 10 cents as an example, closing both sides.
Yeah, let me go ahead and sketch this out for you again, just so you can understand it better. So the first trade we did was sell. The S means sell the 37.5 put, and then we buy the 35 put. And this, once again, is to enter the trade. And sometimes it's good for you guys to sketch it out, especially if you're beginning here. To exit the trade, you're going to do the opposite. In this case, you're going to buy the 37.5 put, and you're going to sell the 35 put. That will exit the trade. You will be out of the trade. There'll be no more rights or obligations. If you happen to have taken 90 cents in, how do you know if you made money? If you took 90 cents in as a credit and you don't have to pay more than 90 cents when you buy it back, you've made money on the trade. Always remember, this is done as a spread. We exit as a spread. It's the easiest way to do it, especially for the beginners. Legging out of a trade means buying one end before the other one, or selling one end before the other. I prefer that, you guys to go ahead and do this as a spread. It's a lot easier way to do it. Unless an option you sold becomes, very inexpensive, and you may want to just buy it back anyways. And that's always a good thing to look into.
Okay, let's go ahead and move forward. We're going to do a case study now using the wealth builder strategy. Now, the wealth builder strategy, George, first of all, number one rule is we're going to be using options that are greater than 9 months to expiration. We're going to be looking at leap options for our wealth builder strategy. So, looking at research in motion, the last trade I have here is around $75. So we're going to put in $75, and then I'm scrolling down. Now, again, why did I pick research in motion? How are you going to pick stocks for the wealth builder strategy? You're looking for good stocks that have that long-term continued move up. All right, where can you find these long-term stocks? Well, you're going to look at long-term trends, and maybe you're going to use a little fundamental information. Make sure it's a company that actually makes money. Right, George?
Yep. Research in Motion is a very strong stock right now, given they're the makers of the BlackBerry. And if you ever talk to people who have a BlackBerry, I do have one, they just love it. I mean, they think it's a great way to keep in communications.
Right. And so, you're going to look for something that continually has great earnings growth, but really also has a good technical pattern, too. I mean, that's really more important to me. News, to me, is already built into the price of a stock, but as a technical trader, I like to look at what those chart patterns are telling me and how much strength there is below that chart. That's just one way I look at these. And if you really want to learn technical analysis, folks, we do a bonus section at the live events. So for those of you that don't know technical analysis that well, that's one way of learning how we look at technical patterns. Now, what we're going to do is we're going to use research in motion as an example. I'm going to look, because it's also a wealth builder strategy, because we're going far out, in case sometimes a couple of years, we're going to be looking at in the money options, deep in the money options. In fact, we're going to probably be looking at the deepest in the money options that we possibly could, because we want to put together a trade that has a real fat credit to it. This is not risking $1.50 to make $1. All right, in this example, we're going to look at all the way down to January 07. We're going to go out a couple of years in the future from where we are today. So we'll go out 2 years. We're going to also look and see, George, that we have the 110 and the 120 strikes. This is a good example to start with.
Okay.
Now, I'm looking at the 110. We're going to be buying the lower strike put, selling the higher strike put. Now, here's where we're going to need to do a little negotiating, because sometimes the difference between strikes can be a little bit high. There's a 60-cent difference between the bid and the offer. So the bid is at 42, and the offer is at 42.60. So, George, you think we can probably get this trade for $42.50?
Yeah, let's try to do that. Yep.
I mean, 10 cents off is nothing. I think that's an easy fill. Now, let's look at the 120 puts. The 120 puts are $49.90 buy 50-50. So I think we should be able to sell this for $50 even, very easily.
Okay.
So we're buying for 42.5. We're selling for 50. That's going to be a credit. And how much is our credit?
$7.50.
Okay, so we got a $7.50 credit. What's the difference between strikes?
10 points difference. So that will be your risk.
So our risk is going to be $10 minus $7.50 equals
$2.50.
So, folks, you can see here we've put together a trade that has a much, much greater reward than it does a risk. Now, this is also 2 years out. Now, any points you want to make on this, George? Where does research in motion have to be? First of all, in 2 years, does it have to go up there in 2 years in order for you to make money? You know, these are some questions I think about when I put on the long-term spreads.
Yeah, this is a type of trade that you're not going to be watching it every single day and saying, oh, it's up, it's down, or whatever. You're basically expecting the stock to start moving up. It doesn't have to go up to 120 for you to start making money. It just has to start moving upwards. I like these types of trades. One word of caution that I want to bring up is just make sure you don't sell options that have absolutely no time value. What that means is you got to be very careful. If you sell something with no time value, you have the risk of being exercised and assigned very quickly. Isn't that correct, Tom?
Yeah, but you know what, George? There is a way to get around that with some stocks because, something we haven't discussed yet is what's called American versus European exercised options and the role they can play in a vertical spread, such as a credit spread. If you use American exercised options, remember, folks, American exercised options, the buyer of that has the right to exercise at any time during the entire timeline process up until expiration. With European exercised options, works a bit differently. You cannot exercise until expiration day. So if that's the case, that gives the seller a little bit of, an added advantage. So if you're putting a credit spread together and you use European exercised options, then that's one thing you don't have to worry about. You can then take that out of your time. Now, George, if a person elects to do a European versus an American, are the prices on the spread going to differ at all?
Yeah, what happens with European style, and this sounds a little mathematical here, well, really what they're going to do is discount. If you're going to sell a put, they're going to discount by the interest charges what you're going to get for that put. So let's say you sell a put, in this case, to the year 2007. What's going to happen? There'll be an interest rate factor that they're going to say that they're going to discount for what you're going to get. So it's a mathematical formula, but however, computer systems will calculate this for you, so you don't have to sit there and do a hand calculation.
The good thing is, George, is that it's calculated on the buy side as well as the sell side,
Sure.
So it actually doesn't come out to be that much of a difference as a vertical spread. Now, if you do this in something like a calendar spread, it could come out to look really weird. Like, for instance, it would look like you're actually getting a credit when in fact it could continue to move in one way or the other. So it's not something we recommend doing in anything other than vertical spreads. But a vertical spread makes very perfect sense because it then just leaves an additional variable out that would have happened if you had an American exercised option.
Sure.
Now, not all stocks are European exercised. How does a trader find out what's European exercised and what's not, George?
Typically, it's an index that'll be European style. Go to the exchanges, and they'll have a list of the stocks that are European style. If you go to CBOE.com, the Chicago Board Options Exchange, that'll give you information on what's European and American, and you'll be able to find those indices typically that are European style.
Okay, last thing I just want to point out about the Wealth Builder strategy, and then we're going to move forward, is you're going to enter this strategy the same way you did as an income strategy. It's entered as a spread to open as a credit, and then it's exited as a spread to close as a debit if you do close it out at all. All right, let's go ahead and talk about bear call spreads. Now we're going to look at the consideration that we're bearish in the market. The objective is, again, we're taking a credit. The objective, just like bull puts, is that we're getting a credit into the account on one option. We're paying a debit on the other for protection. The result is going to be a credit. And then also we can look at long-term and short-term strategies, although it's going to be a little tougher. Don't you think it's going to be a little tougher, George, to find a wealth builder strategy on something that we think is going to move down for a couple of years?
Yeah, typically you've got to find in catalysts or reasons something can go down. 2 years is a long time for a stock to keep going down. So this is a lot tougher in that case.
Right. I find that we find more wealth building strategies on the bullish side than we will on the bearish side. Looking at the market overview, basically the same thing, folks. Market conditions, however, in this case, is we're looking for bearish markets with high volatility. But again, we're still doing this at a credit. We still have a maximum risk and a maximum reward, which are limited. Our time frames can be short or long term. Again, the rights and obligations are basically, you're as the buyer of an option, you have rights. As a seller, you have obligations. As a spread, you have a combination of the two. All right, we're looking at in-the-money options for our wealth-building strategies, and we're looking at the money to out-of-the-money options for our shorter-term income-building strategies. Okay, so let's look at trade legs and how they look using a bear call spread. So, for instance, we're going to buy a higher strike call for protection. We're going to sell a lower strike call for income. If XYZ is trading at 30, here's an example of a bear call spread. We could buy the July 32.5 call and sell the July 30 call. And so some details you got to notice, folks, is that number one, it's all calls. Number two, the same month to expiration. And number three, one-to-one relationship. So every call that we're buying, we're going to sell a call. All right, George, you want to illustrate this for us?
Yeah, so going to our pad here, what you have is we're going to buy the 32.5 call. Once again, that's for protection in case you're wrong and the stock starts to move up. And we're going to sell the 30 call. Remember, if you sell a 30 call, you're going to get more money than when you buy. You're going to have to pay for the 32.5 call. So what this is going to do is create a credit to your account. So you're going to sell something with more value. This will have a higher value, and this will have the lowest value. Okay, and very similar to what we had in a previous discussion of the bull put. Remember, the difference between the strikes is the most you can lose here. What you've done here by selling the 30 call is you've created an obligation if you're wrong. So what you've done is you've actually got rights and obligations. They're going to cancel each other out. So what happens here and what you're trying to do is if the stock happens to break down below the 30 call and it closes below that 30 call of expiration, what's going to happen is your options expire worthless and you get to keep the credit.
Okay, so let's use an example using Intel. Let's assume Intel's trading at 25. So an example of a bear call spread, if you expect Intel to trade lower, the difference between the two is a 50-cent credit. Remember, just like the bull put spread, the credit's received is the maximum amount of profit you can take. The risk is going to be the difference between strikes minus the credit received. Again, just like the bull put spread. The reward, again, is the maximum credit received, just like the bull put spread. The break even is going to be the lower strike price plus the credit received. Now remember, that's a little bit different than the bull put spread, but in essence, it comes out to be exactly the same. And in this case, the reward to risk ratio here is if we're taking in a credit of 50 cents, then what are we risking? We're risking $2. So that's a 50-cent reward and a $2 risk. Now, let's go ahead and move to a case study. We're going to use Apple Computer. We'll take it right off the website like we did before. But let's this time assume that Apple Computer is running out of steam and that we think there's going to be a correction. Again, what I'm going to do is I'm going to go to the website and I'm going to find high volatility. And I'm going to look at the example that I'm using with Apple Computer. So I'm going to click on Apple Computer, and it's going to bring up the stock chart and show me the stock chart. But in this case, maybe I'm a contrarian. Maybe I think there's going to be a pullback in the stock. So now I'm going to go forward, and I'm going to look at the options. And George, here are the options that we're looking at for Apple looking at a bear call spread. Remember, Apple's trading around 37.5. So we're going to look at a 37.5 call to sell. Okay, we're going to buy the higher strike call, sell the lower strike call. So we're going to sell the 37.5, and right now that can be done for $1.85.
Okay.
And then we can buy the 40 call for 95 cents. So amazingly enough, this is exactly the same price that we could do the bull put spread for. It is we're buying for 95, we're selling for $1.85. That gives me a 90-cent credit. That also gives me a reward of you take $2.50 minus the 90 cents, and that gives me a $1.60 for my risk. So 90-cent reward, $1.60 risk. And again, I can determine my break even on this trade by simply taking my 90-cent credit and adding it to the lower strike. Okay, George, how about the risk graph? What's it looking like?
The risk graph is going to look very similar to the ones we have done before. Okay. Now remember, this is a bearish trade. So what's going to happen is, remember, in a risk graph, and let's go back to what a risk graph is for those of you just starting, you're just going to try to picture risk and rewards, which to me is a very important thing. You're going to have a break-even line of 0. Okay. The break-even is where above it you make money, below it you lose money. Okay. So you're going to make money if it's bearish. So it's going to look, let me change colors here for it. It's going to look something like this. Okay, so it looks very similar to a bear put spread. So a bear call spread, bear put spread are two different strategies, but the risk graphs look very similar, and you're going to be using a bear call spread under higher volatility conditions, where you're going to use a bear put spread. You're going to use it typically when you have lower volatility, because as a debit spread, you're taking money out of your pocket. So you want lower volatility. As when you're taking credit in, you like higher volatility.
Okay, let's take a look at this. Again, how do we enter the trade? We enter it as a spread. We're going to buy the 40 call. We're going to sell the 37.5. We're going to do it for a credit of 90 cents. That's how you call the order in, or that's how you would place the order if you were online. Remember, we are opening both sides at a credit. To close the spread, if you were to close the spread. Now remember, we like to see these expire worthless. But in the case that it's real close and you decide I want to exit this trade, then you would simply reverse the order. You would buy what you sold, you would sell what you bought, and you would do that for a debit, closing both sides. All right. Now let's go ahead and do a practice, a case study. And so what we'll do is we're going to use an example using eBay. All right. So George is going to write down the information I'm going to give you, and what we're going to do is we're going to take a case study so that you at home can practice this and see if you get this correct. All right. Now we're going to take a bullish study on eBay, and what we're going to do with eBay is we're going to now buy the eBay 100 puts, and let's say that our eBay 100 puts are trading for a cost of $10. We're going to sell the eBay 110 puts, and we're going to be able to get a credit of 17 points on the eBay 110 puts. Now, you at home need to determine a few things. Number one, what's your credit? What is your risk? What is your reward? What is your break even? And I also would like you to draw the risk graph on that. So what I'd like you to do now is go ahead and pause your DVD and do this exercise at home, and then turn the DVD back on, push play when you're ready, and we'll give you the answers. Okay, George, why don't you show the viewers at home exactly how you put this test together and how you came up with the answers.
Let's see, Tom, if I pass. What happens? You fire me if I fail?
You're fired.
You're fired. Okay, anyways. All right, let's take a look at the numbers here. Tom gave me an example with eBay, which is a company we feel pretty good about. We sold the 110 puts, so we're going to take a credit in of $17. We buy the 100 puts, we're going to take a debit. We're going to pay a debit of 10. So if you can take 17 in, but you got to give back 10, my credit is $7. Okay, remember the risk on a trade is the difference between two strikes. So I basically have 110 minus 100, so we've got 10 points difference. So that's my risk. But I took some money in, so I'm going to subtract out 7, and I've got $3 worth of risk. So let's see, you've got $7 in your pocket. So the best case scenario is I keep $7.
All right, last question, George.
Oh, this is the tough one.
This is the bonus question.
Okay.
What's the break even on this trade?
Okay, let's see. So I'm going to think it through with you. So you've got 100. The 110 puts has some obligations. Remember, when you sell an option, you have an obligation here to buy eBay at 110. So let's see. So 110, I've got to buy a stock at 110. I don't want to buy a stock at 110 if it's going to be lower than that. But what happens is you've taken in $7 to begin with. So I'm going to have a 103. Did I get that right?
All right, let's go ahead and go through some final thoughts here on credit spreads, and just really bring up some important points that we just really need to hammer down with you. Number one, wealth builder versus income. Remember, wealth builder strategies, we're using leap options. This is something, like George said, you're not in this to look at it on a day-to-day basis. It's a long-term trade. Income strategies, we're looking at around that 30 to 45 days to expiration, and we're looking to have that go all the way to expiration. All right? In the money versus out of the money. Wealth builder strategies, we're going to be typically using the in the money options. Looking at the income strategy credit, we're going to be looking at the money to out of the money spreads. Okay, American versus European, that becomes a little bit of really a personality for you. You can use either one, although like George said, you're going to need to check with your broker or check with the exchange to find out which U.S. stocks offer American European. Again, you might think, well, all U.S. stocks are American. Actually, that's not true. You can actually call your broker and you can actually get something called a flex option, which will allow you to have it set to a European style option instead of an American. Again, you have some choices there. Next, the probability of credit spreads. Now, this is where income strategies make a lot of sense. You might say to yourself, well, wait, I'm only taking in $1. I'm risking $1.50. Yes, but you know what? If you get a 75% chance that stock is going to stay at or move out of the money, making your credit spread expire with maximum profit, does it make sense that 75% of the time you can take in 2/3 or greater than 1/3 of the credit? And my situation is yes. Here, I'll give you another example. If you could 9 out of 10 times take in 50% of a spread, would you do it? Absolutely. So, probability can work in this example. However, what I really like to look at is I like to look at the technicals of the stock and get an idea of, again, what if I'm right, what if I'm wrong? If the stock continues to move in the direction we expect it to, or it stagnates, that's okay for a credit spread. Where you run into a problem is if it moves and moves against you. And if it moves against you, you want to have a good exit plan. One of my exit plans is that if it drops below some critical support level and you've got a bullish trade on, I get out. I take my loss and move on. And if you have a bearish trade and it moves up above some resistance, that's another good area to get out of this particular trade. Exercise and assignment. George, we talked about 3 different ways that you could get, you could maneuver yourself in and out of positions. What's going to happen, folks, is that either the trade's going to be deep in the money, it's going to be deep out of the money, or it's going to be somewhere in between your strikes. If it's deep in the money, then you're going to be obligated, and you're also going to have the right to exercise. And the worst case scenario that can happen is that you could just wind up getting the maximum risk. But if you knew what the maximum risk was when you took the trade, then you know the worst case scenario that can happen to your trade. If the best case scenario happens, well, again, guess what? We don't even need to take the trade off. Both the long and the short will expire worthless, and you'll just collect that premium, and you won't have to pay that outbound commission. Now, what happens, George, if we fall in between those strikes once again?
Yeah, once again, what you have to look at when you look at your trades is what's going to happen. Worst case scenario is if it falls in the middle, you've got to take some action because one leg will have value and the other leg may not have value. And what's going to happen is, and let's take a look at the boards. If you go ahead and you sell, a call option at 20 and you buy a call option at 25 as protection, and now the stock's somewhere in the middle at 22.5, what's going to happen is you're going to have some obligations because what's happened is the option you sold is going into expiration. What you're going to have is an obligation to buy that stock at that point. So there's a couple things you can do, and probably the easiest thing is just get out of that. Just buy it back when you go to expiration. So if you sold the call, you can buy it back and you're no longer going to be obligated at that point in time.
Right. And folks, if you want more information on the risks and characterizations of options, there's a book that actually comes with your brokerage papers when you complete or fill out an options form, and it's called The Risks and Characterizations of Standardized Options. You can also get this free by logging on to the Chicago Board Options Exchange website at www.cboe.com. One more thing, George. Can I do a bullish a bull put spread and a bear call spread at the same time if I think a stock's going to actually move sideways? Can I actually put the 2 trades on at the same time on the exact same instrument?
It's something for you guys to think about. We've given you examples of taking a credit above and below a stock. Why not do them both at the same time in case it goes sideways? That actually is a real trade, and we're going to show you how to do that on a future DVD.
Right. That's actually going to be coming up next. So once you master this and you understand credit spreads, then you'll be able to do the above and below, which is actually called a butterfly or a condor, and you'll find that here later in this series.